Most people believe market crashes are caused by sudden events, a war, a bankruptcy, a shocking headline that appears without warning and sends prices spiraling downward. This belief is comforting because it suggests that crashes are unpredictable, acts of fate rather than outcomes of design. History tells a much colder story. Market crashes are not surprises. They are conclusions. They happen when pressure that has been building quietly for years reaches a point where delay is no longer possible. By the time panic appears on screens, the collapse has already been locked in by math, not emotion. Right now, the global financial system is entering that final stretch. And the reason the window between mid-2026 and late 2027 matters is not because of speculation or fear. It matters because the structure of the system leaves no room for postponement beyond it. To understand why, you have to understand how modern financial systems actually function. They are not built on savings. They are built on leverage. Governments borrow against future growth. Corporations borrow against future profits. Consumers borrow against future income. None of this is inherently dangerous. It becomes dangerous when the cost of carrying leverage rises faster than the ability to service it. For more than a decade, that cost was artificially suppressed. Interest rates hovered near zero, credit was abundant, refinancing was effortless. Losses could be rolled forward indefinitely. This environment created the illusion that risk had been conquered. In reality, it had only been hidden. When rates finally began to rise, the system did not break immediately. That delay confused people. They assumed that because nothing collapsed right away, the danger must have been exaggerated. This is a mistake repeated in every cycle. Monetary policy does not act instantly. It moves through balance sheets slowly, unevenly, and with long lags. The tightening that began earlier in the decade is only now reaching its most consequential phase. Debt does not fail when it is created. It fails when it must be renewed under worse conditions. And between 2025 and 2027, an enormous volume of debt reaches maturity across governments, corporations, commercial real estate, and private credit. These obligations will not be refinanced at the terms that created them. They will be refinanced in a world where money has a cost again. This is the clock most people are ignoring. At first, the consequences appear manageable. A few restructurings here, a few defaults there. Analysts describe them as isolated. Policymakers call them contained. Markets remain calm because liquidity has not yet disappeared entirely. This phase always feels safe, and it always precedes collapse. Asset prices often stay elevated during this period. That creates false confidence. People assume that high prices mean low risk. History shows the opposite. High prices late in tightening cycles indicate fragility, not strength. Markets are not driven by valuation. They are driven by liquidity, and liquidity is already retreating. Banks are lending more cautiously. Credit standards are tightening. Risk premiums are quietly rising. This process is uneven and therefore deceptive. Some sectors feel stress immediately while others appear untouched. This fragmentation hides the scale of the problem. Another layer of pressure is building at the same time: government finance. For decades, sovereign debt was treated as risk-free. Governments borrowed cheaply and endlessly. Markets assumed central banks could always intervene to stabilize conditions. That assumption is now under strain. Interest payments are becoming a dominant budget item. Servicing existing debt is consuming resources that once funded growth. This creates a vicious cycle. As interest costs rise, governments borrow more. As borrowing increases, markets demand higher yields. As yields rise, interest costs grow further. This loop does not cause immediate collapse. It causes fragility. And fragility becomes dangerous when combined with political constraints. Fiscal reform is slow. Spending cuts are unpopular. Tax increases are resisted. Borrowing becomes the default solution, even when it worsens long-term stability. In previous crises, governments had more flexibility. Inflation was low. Debt levels were manageable. Public trust was higher. Today, those shock absorbers are weakened. This matters because market collapses are not just financial events. They are coordination failures. They occur when confidence evaporates faster than institutions can respond. Another critical factor shaping the next collapse is global fragmentation. In earlier cycles, capital flowed freely toward perceived safety. Reserve currencies absorbed shock. Global trade networks held together, confidence concentrated. That world no longer exists in the same way. capital today is selective. Political alignment matters. Sanctions matter. Regulatory risk matters. Currency exposure is no longer neutral. Central banks hedge rather than accumulate. Trade increasingly bypasses traditional channels. This fragmentation does not end the system overnight. It weakens it. It reduces the ability to absorb shocks when they arrive. Liquidity that once stabilized markets is now divided across competing blocks. When stress hits, there is no single pool of confidence large enough to catch everything at once. All of these forces converge toward the same period. Debt rollover pressure peaks. Fiscal stress intensifies. Liquidity thins. Capital fragments. None of these alone guarantee collapse. Together, they make postponement impossible. What ultimately triggers the crash will appear trivial in hindsight. A failed auction. A corporate default. A banking consolidation that reveals hidden losses. A geopolitical shock that forces repricing. The trigger is never the cause. It is simply the moment when reality becomes visible. When that moment arrives, markets do not decline slowly. They reprice violently. Forced selling begins. Margin calls cascade. Correlations spike. Assets once believed to diversify risk move together. The narrative flips overnight. Stability becomes fragility. Resilience becomes vulnerability. What was dismissed as impossible becomes obvious in retrospect. The reason the mid-2026 to late 2027 window matters is because this is when delay ends. Obligations must be met. Refinancing must occur. Losses must be recognized. This does not mean collapse will occur on a specific date. Markets do not obey calendars, but cycles compress. Probability clusters. Risk concentrates. The cost of being wrong increases dramatically. History does not repeat perfectly, but it obeys patterns. Systems built on leverage always fail the same way. They fail when the future can no longer pay for the present. The next phase of this story is about how collapse actually unfolds once recognition begins. Why policymakers respond too late, why initial interventions fail, and why the most dangerous moment is when people believe the worst has already passed. That comes next. What ends eras like this is not disaster but disbelief. A slow spreading doubt that the future will behave the way the past did. Financial systems depend less on optimism than on predictability. When predictability erodes, behavior changes before prices ever do. Late in a cycle, the most important signals are invisible to most people. Long-term planning quietly disappears. Decisions become provisional. Commitments are shortened. Institutions stop building for expansion and start preparing for exit, even if they never say it out loud. This is how systems hollow out. At first, nothing looks broken. Transactions still happen. Markets still open. Profits still appear on paper. But the character of participation changes. Capital becomes cautious. Risk tolerance narrows. Every action carries an unspoken condition. When enough participants behave this way simultaneously, momentum collapses. This is when liquidity begins to fail, not because money vanishes, but because trust in continuity does. Lending slows because uncertainty cannot be priced. Deals fall apart because assumptions no longer align. Capital waits instead of committing. Waiting spreads faster than fear. Prices during this phase often remain high, which confuses observers. Stability is mistaken for strength. In reality, prices are being held up by habit and delay, not conviction. People stay invested because selling feels unnecessary, not because they believe in upside. This equilibrium is unstable. Once selling begins, it accelerates quickly. Not because people panic, but because systems are designed to respond in the same way at the same time. Risk limits trigger. Models adjust. Collateral requirements rise. Selling becomes compulsory. This is why downturns feel sudden. The visible movement happens fast, but the decision to unwind was made long before. As markets fall, intervention follows. Authorities speak. Tools are deployed. Prices react positively for a moment. Confidence flickers. But this response misunderstands the nature of the breakdown. The problem is not shortage of money. It is excessive promises. Too many claims exist relative to what the future can realistically produce. Liquidity can postpone recognition, but it cannot restore feasibility. Once this becomes clear, behavior shifts again. Institutions stop reacting to policy and start reacting to each other. Defensive positioning replaces participation. Capital preservation overrides opportunity. This collective inward turn drains the system of energy. As credit tightens further, financial stress spreads into the real economy. Investment slows. Hiring weakens. Consumption softens. These effects reinforce market pressure, creating a loop that feeds itself. At this stage, financial instability and economic instability merge. There is no longer a boundary between markets and society. Public trust erodes as expectations break. Political narratives harden. Blame replaces explanation. Cooperation gives way to suspicion. These outcomes are not external to financial crises. They are integral to them. Governments respond under increasing pressure, but every response carries consequences. Support risks inflation and currency weakness. Restraint deepens contraction. Delay destroys credibility. No option restores the previous balance. This is why late-cycle policy always feels ineffective. The system is no longer seeking reassurance. It is seeking resolution. Resolution requires adjustment. Debt must be reduced, explicitly or implicitly. Assets must be repriced. Ownership must shift. Losses must be absorbed somewhere. History offers no example where highly leveraged systems avoid this process. The form varies. Defaults, inflation, currency erosion, restructuring, often all at once. But the outcome is the same. The past can no longer be financed by the future. Once adjustment begins, the world reorganizes quickly. Capital becomes scarce. Risk tolerance collapses. Growth slows. Innovation redirects. The assumptions that governed the previous era lose relevance. This is why recovery never feels like a return. It feels like entering a different phase of history. The greatest mistake is believing that stabilization means restoration. Stabilization only means the system has stopped falling. It does not mean it has regained what was lost. This is why timing matters more than prediction. Between mid-2026 and late 2027, the system enters a phase where exhaustion replaces endurance, where delay stops functioning as a strategy, where obligations outweigh optimism. No catastrophe is required. No singular event must occur. The machinery is already operating. Crashes feel shocking only to those who confuse survival with sustainability. History does not announce turning points, it reveals them afterward. And systems built on leverage always reach this moment, whether people are ready for it or not.